Hello, clients and friends. This is Robert Scott, and we're calling from our office here in Pre-Emptive Financial. We want to welcome you to our first quarter review. It's very interesting how we've had so much going on in this quarter. I'm really happy to share this update with you. So the first thing we want to bring out is we really believe an educated client is our best client because knowledge is power and enables us to make good decisions. So what's happened in our equity markets? You know the headlines. Russia invaded Ukraine in February. Inflation hits a 40-year high, and the new number came out today, 8.5% inflation. Interest rates have increased by the Fed, and equity markets have experienced the worst period since the first quarter of 2020. So it's very tough stuff that we're talking about here. It's whirlwind of activity. And we note here how this has affected the equity markets. S&P 500, the average of U.S. stocks, is down 4.9, and the Dow Jones Industrial Average is down 4.6. So volatility is the big expression of first quarter 2022. After several drops at the end of the quarter, equity markets began to rally, and March brought it up about 3%, but that still left us at a negative. We didn't reach the values from the beginning of the quarter. So this is the first losing quarter that we've had in 24 months. As we mentioned the numbers already. So inflation is at a high, and you may note this little graph here shows that in 2020, inflation was 2. During COVID, it dropped below 2. And then right after the election became done, that's when inflation started up. Here's a very useful chart. This one right here, it shows that we're feeling the effects of inflation. 2010, a full grocery basket, 2015, half full, and 2022, it's very expensive to purchase. Now, the Fed wants us to have about a 2% inflation rate because that keeps the economy moving the right way. This high inflation is an enemy to us investing wise. So, what can we do? We can't avoid it. It's impossible. You go to the grocery store, you go to the gas pump, you go and pick up clothes, you go pick up car parts, home repairs. Everything has gone up. And so consumers are feeling this squeeze. So how do we cope with it? Here's an interesting thing about interest rates. You note there that this is the federal funds target rate, and we've got a little bump up here. Now, last week, they didn't raise them again. They gave economic conditions due to the Ukraine war, so they kept them at 25 bips, which is fine. But they're going to also start unwinding their bond holdings here in the month of May. So this would be, it would bring the same effect as raising the rates. So this is going to start. Now, what will it go for? We don't have an exact idea what the Fed is going to do, but they are talking to maybe 3 interest rate increases. That affects credit cards, that affects a lot of things. So we'll talk about that in a little bit. Important point here is about bonds. So you see the graph on the left, interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Now, typically, we have seen bonds are used to protect from a volatile market. But because interest rates are going up, bond prices are dropping, it is not beneficial for bondholders. Even though that's considered stable, there's volatility in the bond market as well. And the first quarter of 2022 was the worst quarter bonds have had in 40 years. And that's because of the inflation and the interest rate increase. Here's a graph showing the 10-year Treasury as opposed to the 2-year Treasury. And you've heard the term the flattening of the curve. What that means is when the 10-year and the 2-year start to go close, they're concerned about that. It did actually inverse just a few weeks ago. It is almost back to normal. So we're seeing if this is really going to affect the markets or not. Um, as these interest rates rise, so it will make bond yields go up. We expect those yields to go to 3 in 2023. But this is not a good time for us to ignore our bond holdings. A good time to review. Let's see what exposure we have. Let's make sure it's a good fit for our goals. So please contact us if you have concerns about your bond holdings. This is the cost of safety. You say, oh, get me out of the market. I'm going to run to the bank. This is what you get in a bank money market, 0.07%, in a 12-month CD, 0.2, and that's Barron's as of April 3rd. So you see the rates haven't really improved enough that we can say run to the bank, because that's not good. These ultra low interest rates do not help you to reach your goals. And so, really, the place to go to is equities in a diversified portfolio. So, we'll talk about that here. So, we have to be prepared. Benjamin Franklin said, failure to prepare is preparing to fail. I read that wrong, didn't I? Failure to prepare is preparing to fail. So we have to proceed with caution, being prepared. So what do we look for? Interest rate hikes, borrowing has become more costly, and variables that could affect the speed and direction of the economy are multiple. There's not just one that's doing this. So if you're planning on buying a house or a car, a large purchase, expect the borrowing to cost you a little bit more. There are other variables. The war in Ukraine has affected some of the food prices and also oil pricing, and we have to become more disciplined and focused. And we haven't even talked about what the pandemic of COVID-19 has done. So what our job is to do is to keep track of these changes and how that affects your personal situation. So here's what we ask that you do. Let's look at all your income producing investments, bonds, dividend holdings. Lock your mortgage rate if you are considering doing that. You may be at a very good rate already, which I'm very happy about. You might consider refinancing. What looks bad now will be even worse in a few months if interest rates continue to climb. Maintain liquidity for your near-term needs. We call that emergency fund, or you might call it your checking account. What we are interested in is that we can cover liquidity that may come up. That way we don't have to go in and sell investments at a lower price. Rather, we can maintain our investments and let them flow through the market. So relook at your budget. We're looking for cash flow needs. Are you making enough from your job or from your Social Security and your benefits, perhaps from annuities? Uh, do a full review of your financial plan with us. That's where we need to be. Our recommendation, stay on the course. The current noise is a distraction to the investors. You probably noticed the headlines move back and forth. Ukraine, COVID, unemployment figures, and all these other things, inflation, and so on. But we have to remember something. There's discussions being used today called stagflation. That's a term that went back to the 70s. Stagflation is high inflation, high unemployment, and slow or no economic growth. Now, we're not there. We've got high inflation, but unemployment is low, and people are still getting jobs. There's economic growth because people are going back to work. So we haven't hit stagflation. Oh, could we have a recession? Perhaps. The first quarter was a decline. We need 2 quarters to call it a recession. However, it is wise for us not to get into the boat of predicting the future. Instead, we look at your long term goals, your long term objectives, and then we set our strategy, and like the sailor has here, we stay the course. Discipline and staying on track is the best strategy during times of volatility. We're here to help you discuss and pursue your goals. So if you wish to revisit your plan and discuss with us any concerns or ideas, please call us or bring it up at our next scheduled meeting. We want to help you succeed. So, what are our key takeaways? We've got volatility. Everybody knows that. Interest rates are on the rise and expect an increase faster than they originally thought because inflation is high. Um, what can we do about inflation? Mind our spending. Do what we have to do. And if you want to do other things because you have an abundance, that's fine. But just remember you'll pay a little bit more. There are many factors that could affect the direction of the economy and the markets. There's the political, the geopolitical, COVID, and so on. Where are we right now? We're in a very interesting point because the directions of the markets could change drastically. So, what are we saying? Caution. Let's be cautious. That's where we want to be. Watch your things and then call us with any questions or concern that you may have. As of note here, since you're a client of our firm, we ask you to help us add names to our list to receive newsletters and presentations. Um, if you help us with this and add 2 names or more to our list, that gives you an opportunity for a very special event that we hope to have this year that we haven't had because of COVID. So very soon, we hope that will work out. Here's the fine print. And we want to thank you very much for your kind attention to our program. And please feel free to communicate at any point. We do appreciate all that you do, and we hope that we can help you reach your goals. Bye bye.